No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about the stock market today. One of the things I'm hearing quite a bit from new clients that are coming in is that of what's going to happen with regard to the election and the stock market. Is it in fact going to cause us to have a big drop in the market after the election? And does it depend on who gets elected as to whether we'll have that drop? These are all some of the questions we're going to delve into. Another is, and this is a bigger indicator. So here we are, the election is less than 3 weeks away, and we're concerned about who's going to win. If Hillary wins, is that going to be good or bad for the market? If Trump wins, is that going to be good or bad for the market? In fact, is the stock market, the uncertainty of leading up to the election, does that have anything to do with what kind of volatility we may see? And also, of course, then what happens after? Here's another one. The Federal Reserve's talking about raising interest rates, okay? They've been giving stronger and stronger indicators that they're at least going to do one increase by the end of the year. All right, what effect will that have? When we look back at December of 2015 and we see what the effect was then, we saw the stock markets kind of swoon in that first month or so. So this is another part of what one of the things that we're looking at with regard to, in particular in the short term, of effects in terms of volatility. We're also going to talk, though, about some other indicators with regard to where the market is going. Now, I've talked in previous shows about some things like John Bogle. He's the founder of Vanguard Funds, of course, and Bogle has said that the expectation is two bear markets of anywhere from 20 to 50% over the next 8 to 10 years. We've had also BlackRock say that we're expecting low returns over the next 10 years. Domestically, the expectation is around 4%. Same thing again, Bogle, the founder of Vanguard Funds, has said something very similar, not only about the bear markets, but also that your average return to be expected out of the U.S. market is around 4% over the next 10 years. There are others. McKinsey Institute, one of the research institute, one of the things they put out, again, is, in fact, we're going to get into today, talks about not only in the U.S. but also internationally, so even international emerging market stocks, what impact are those numbers going to look like? Well, in this situation, we're seeing low trends going forward in terms of very low single-digit types returns from the stock market, higher volatility, so it's going to be quite a roller coaster to even get there. And then we're also going to be talking about another indicator, and this has to do with margin debt as a bear market indicator. What that means basically is this. There are people that borrow money to invest in the stock market, okay? This is called, having a margin account. So what they do, what we compare then, there are indicators such as margin debt relative to GDP, and what that does is it gives us an indication of whether or not people are getting a little greedy they're feeling, oh, I want to get more, so they're borrowing more money to invest in the stock market. When we see those numbers typically go up, that's a sign that the market could in fact be heading for a bear market, and that's what that's an indicator, in fact, over the last two bear markets, 2000 through 2002, and in 2008, started in October of 2007 actually through March of 2009, that bear market. Both had this indicator, if you will, peak just before the bear market. So these are some things that we're going to be talking about today, because the concept is this: when you're investing in the market, if you knew, all right, or were pretty certain that the market was going to take a tumble, all right, in general, would you stay invested in the same way you are currently? All right, would you be doing the same things? So here we're talking about, if you know, okay, over the next, say, there's a strong possibility over the next 1, 2, 3 years that we're going to see a potential for a bear market over that period and low returns, okay, for the next decade, would you take another look at how you're invested and try to, in fact, find some strategies to help protect yourself, not only against a market downturn, but to be able to ride one out and recover faster, all right? So that, and I'll give you an example. 2000, because this isn't new, all right? These are cycles that we see in the market. When in the 80s and 90s, we saw a strong bull market where we had a lot of great returns, but there were a couple of dips in there, of course, as well. And you're going to expect, in fact, that statistically somewhere, depending on how strongly you're invested in the market, in other words, how many stocks to bonds in your portfolio, you can expect 1 in 3 to 1 in 4 years to be negative years. All right, that's the cycle. That's the way it works. It doesn't mean, oh, I had a negative year, therefore I'm going to get 2 or 3 good years. It can be all over the place. You may have 2 or 3 years in a row that are negative, followed by 4 or 5 that are positive, that kind of thing. All right, so again, understanding, though, how you're invested and how that works. So the S&P 500 index, as an example, in 2000 through 2002, dropped about 44%. It took, from that period, about 5 years to recover from that. All right, and get back to where you started. So in other words, whatever amount of money, let's say you had $250,000 invested at that point, or make it even $500,000 in your pocket. $500,000, you'd have lost almost half of it. It'd be worth about $250 at that point. Then it took to get back to that 5. It took about 5 years after that to get back to that original 500 you started with. Then in 2007, the market peaked in October of 07, dropped about 55% over the next approximately 18 months. All right, so in that period now, here we are, we're back to our 500, and we actually made a little bit of money, and then boom, we're back down around 250 again, okay? So this is the kind of cycle that can happen, and it took, again, about 5 years to recover from that period. And that's 100% invested in stocks. Now, most people are going to be invested in a balanced portfolio of maybe 50% stocks and 50% bonds. You may ride that out a little bit easier, okay? The bonds, if they're done correctly, all right, meaning that if they're short-term investment grade, good quality bonds, then you may have done, you probably would have had about half that type of drop and hopefully would have recovered faster. The more diversified your portfolio, the faster the recovery. So for instance, in the portfolios I use with my client, we have 16,000 stocks in those portfolios. And when we blend together in the fixed income side, these are short-term investment grade bonds, okay, corporate and government bonds, typically 1 to 5 years with maybe a small amount in a 5 to 7 year intermediate range. All right, so when we're looking at a portfolio like that over that same period, 2000 through 2002, basically about a break even, lost maybe a fraction of a percent. So on a $500,000 investment, you might have lost a couple of $1,000s is all, okay? You'd still have about $498,000. Then it was rolling, then in the positive years. And then in 08, when the market dropped, in that situation, as I mentioned, this in 08, it dropped about 38%. Then we would have had the, we don't need that one just yet, Marilyn. That we're going to come to in a minute. So then we're going to have, at that point, the balanced portfolio would have only dropped about 20% over that period and would have recovered in about 2 years instead of 5 years. So this is how the market cycles go. Now, this particular slide we've got up is margin debt as a bear market indicator. So we're going to talk about different indicators, and we're going to get into the election and Federal Reserve and that. This particular one, as I mentioned, is an indicator of tracking, again, margin debt, how much people are borrowing. And as you can see, as I was mentioning, through 2000 and 2002, you can see on this chart the graph is basically showing that red line that is tracking the ups and downs, and the ups and downs represented by the bar graph. What we're seeing is that the market peaks about the same time this margin debt peaks, the market then goes through a bear market cycle. That's what happened in 2000 through 2002. It's what happened from October of 07 through that 08 period up through 09. We've seen a little bit of a trough just most recently, and now we're peaking again. So we're seeing this peak, as you can see, where a lot of that greed, if you will, of people borrowing more now, thinking, ooh, this is a good time to get in the market, so they're getting greedy. Now, what is it that Warren Buffett said? When people are getting greedy in the stock market, that's a time for us to be fearful. Okay? Well, this seems to be one indicator that this may, in fact, be a good time to be fearful. This has been a good indicator of when to see a bear market. Now, bear market, by loose definition, is a drop of more than 20% in the stock market. So that's one. We're going to talk about additional drops here as well. So that's 20% is that official bear. We've had some parts of the market that have had a correction of, say, 10 to 20%, but we haven't really had that bear market period as we saw in 2002, 2002, and in 08. So we're going to talk about just how close that may be, and also some strategies on how to invest. We're going to talk about portfolio construction this morning, because that's going to be one of the biggest ways that you can help protect yourself, as well as some hedges against negative markets. All right, a lot to get into. Help keep that money in your control, in your pocket. Join us here. We're going to get into that and more. We'll be right back on the Retirement Report.